be here. Yeah, I mean, it's strange how the narrative is shifted in a month. I think I was on your channel a month ago and people were saying, where is the bottom? And now the narrative has changed to did we miss the bottom? But that's the nature of the beast. That's the way the market is. It's extremely volatile. I think the sell-off that we saw in February, March was extremely sharp. But if you go back and look historically at 2008, 2009, or even in 2000, 2001, it's a pretty normal characteristic that when the market falls quite hard, you then see a attempt to bounce back again. And I think that's what's going on. And of course, you've had global support, particularly look at the way the US market, which is the Pied Piper, has done. So all of that is sort of helping things along. My sense is, once we've had this outbreak of volatility in Feb, March, it persists for a while. It won't vanish. So we're still in volatile times. Valuations attractive, not as cheap as they were at the lows, 30 days ago, but still certainly well below the long-term average.
Okay, but for a person like me who tracks macros more than markets, the news is still disturbing. But a combination of a finding of a drug as well as extraordinary pumping of liquidity by the Fed can keep markets giddy or keep markets bullish for a very long time, you think? Or will macro reality strike maybe in a couple of months?
That's an interesting question, Lata, and we've spent a lot of time thinking about this over the last 1 month. But I think two things we need to keep in mind. Yes, no doubt our economy was already on a little bit of a weak wicket before this whole COVID-19 outbreak happened. The fact remains that what has happened now is not a typical business cycle event. You've had governments come in and say stop all economic activity. It is not a normal business cycle where something has gone wrong. It's not really a repeat of the GFC where you had a problem in the banking system. So this is not the business cycle. This is not the economic cycle. Now, when governments ask economic activity to come to a halt, it is therefore only logical that at some point those same governments, and using the monetary firepower as well, will have to provide the lubrication to get the economy back on track, simply because it's not the standard business cycle. So I think, we've seen some of the economies, particularly the US, come out all guns blazing in terms of the size of the intervention, both on the fiscal side as well as on the monetary side. In India, it's been a lot slower. Whatever interactions we've had with government seem to suggest that they don't want to do anything very rushed or in sort of a big bang approach. Their thinking is more to do multiple interventions and targeted interventions. And so be it, that's more about the tactics than the strategy. But I think eventually there will have to be monetary and fiscal firepower put to this, simply because it's not the economic cycle. You have asked economic activity to come to a halt, and therefore it is incumbent upon the fiscal and monetary authorities to help the economy get back on its feet.
Okay, by the way, right now the market is just up and away, and it's not showing any signs of cool off. Maruti is now joining the party along with Tata Motors. That's up about 6% right now. Vetri, good morning. This whole debate about autos, under ownership, and the fact that a lot of people are saying a post-COVID world will see return to private ownership. Do you think that's a good enough argument along with valuation to perhaps look at auto stocks once again constructively?
Yeah, good question, Anuj. To answer the second, or rather the point you made about whether perception will change. I think there's been some data out of China suggesting that consumer sentiment towards auto has been very positive, simply because people want to get away from mass transport and want to have their own personal transport again. So there have been reports of a strong bounce back in auto sales when business activity resumed. Maybe that'll have some impact here as well, because remember, particularly in the big cities, we are very dependent on large mass transport systems, and maybe a little bit of risk-averse behavior from customers might cause them to look for alternates, which could be two-wheelers or four-wheelers. But, when I think about auto companies, honestly, our sense much before we actually, saw this data point in terms of Chinese demand picking up, is that valuations had actually become quite attractive. Many of the automobile companies in India, not every single one, but many of them have actually fairly strong balance sheets. They generate a fair amount of cash flow. They've demonstrated strong profitability in the past. So the valuation valuation argument to buy them was already there. We were overweight automobile even a month ago, and we remain happily overweight over there. If there is a bounce back in demand because of this fear factor, so to speak, I'm not complaining.
Okay, and the other part of this whole equation, Vetri, is about the expensive stocks. I know you don't talk stocks, but the likes of a PVR, so many stocks, Bajaj Finance, where we've seen a damage to prices, and a lot of people believe that earnings will see a recurring hit. Do you think that's a fair argument, or do you think some of these marquee stocks are giving a re-entry opportunity?
I don't think there is a one-size-fits-all answer to that, Anuj, and I would actually be cautious and would caution anybody about just adopting that one-size-fits-all approach. I mean, we've seen in the past as well, market cycles which are adverse, economic cycles which are adverse. Some companies have the ability to bounce back. They come back twice as strong. So I wouldn't want to generalize that. I think where perhaps companies don't execute well, or it appears that through this difficult period, we start to see chinks in their business models. Yeah, some of them might struggle, but some of them might actually come out twice as strong. So I would not generalize there. I think, unfortunately, we don't talk stocks, but I think really investors need to take that call stock by stock rather than generalize.
Vetri, good morning. Been listening to your views, and I just want to get back between, perhaps a disconnect between the market and the living reality. Sure, markets always move way ahead of the living reality. But here we are at 9,700, whereas I can't even go outside and even think of having a cup of coffee, and I don't know when that's going to happen next. So what are we missing here? I mean, sure, if a drug comes in, then all bets are off. Then we know what's happening to this market. But what is the market pricing in? Has it priced in a partial lift, that supply chains will still be broken, maybe lockdown is reimposed in some parts? What is this market pricing in?
Well, I think the key point to keep in mind is that eventually stocks trade not on the basis of what happens in 1Q21 or 2Q21, but what really happens in terms of earnings over a 5-year, 10-year cycle, right? Otherwise, why are you paying even a 10p multiple or a 20p multiple or 30p multiple for a stock? And I think as far as the fact about, when will the medication come, I think you just have to be a little bit optimistic over there. There are thousands of years of human history. We've overcome multiple pandemics, and we've got the finest minds in the world looking at how we can now tackle this problem using medicine, using technology, and I'm sure something will emerge over time. As far as the disconnect is concerned, what's new about that? Some of us were screaming from the rooftops in 2016, in fact, forget 2017, even in 2016, that mid-caps were atrociously expensive, but they went ballistic in 2017, and then you got the next 2 years where, there was major pain that came in. So I think trying to connect immediate data points to stock prices is fraught with danger. We tend to prefer to look at it from the prism of valuations. And as far as valuations are concerned, the market actually went down to pretty cheap territory 30 days ago. It's still trading well below the long-term average. And I think certainly things look positive towards equity. But don't read too much into these manic moves. That's more a function of some of those traders that Anuj was talking about, who are trying to go long or short every day, and they create the volatility in the market. But as an investor, I think you just need to take the long view over here.
It's a very convincing answer. I've completely taken everything that you said on board, Vetri. So in that context, what is the ideal portfolio for the next year or two? Is it going to be more loaded with staples? We've been getting some negative calls on IT as well. Will it have more of pharma? What's it looking like?
Again, great question. And, at least my philosophy here has always been that let the valuations tell you where risk is or where risk is not, rather than being guided by narratives about who will come out stronger. And I think the key here is really not about sectors, it's about stocks. The reason I say this, when you look at the marketplace, in every sector there are cheap names and there are expensive names today. It's not that the staples sector is only got costly names. I assure you there are many names there which are cheap as well. So I think the key as far as we are concerned in terms of generating alpha, because that's what our job is as fund managers, is to get the stock selection right. Don't sweat the sectoral views. Things are evolving. It is still very early days. There will be disruptions. But I'm hoping that the stronger companies, the ones which have cash on their balance sheet, which have strong cash flows, which have strong management expertise, are the ones which will figure out how to get business operating in this new environment. So it's not so much about which sector you buy, it's about the stocks you buy. And I think experiences like this, when you see the market really take a big knock, once again are reminders that it's only the good companies that eventually bounce back. There will be some companies even in our portfolios where, as we look at them today, we know that they're going to find it challenging, and we are on guard to figure out where we need to double down on them and where perhaps we need to, change our stance. But I would say think about it at a stock level. Don't get trapped in this sectoral views. This is not the right thought process right now. It's all about companies.
You know what, I can say that back to you. Why don't you talk stocks rather than tell us only about sectors and say that, oh, I can't choose sectors. We really wish you would. But okay, let me end with one sectoral question, Vetri. Will finance as a sector lose its primacy? I mean, we know the problems of the NBFCs is now expanded to the debt AMCs, debt mutual funds. And ultimately, a lockdown economy will tell on the bank balance sheets. So will it lose its primacy? I'm noticing in your own funds, finance obviously holds the prime of place. Will you be trimming it?
That's a good question, Lata. And I think, like it or not, when the economy faces troubles, whether it's a business cycle problem or it's a virus problem, end of the day, everybody else's problems at some point runs the risk of becoming the bank's problem. So I do think the banks and the financial institutions will face challenges during this period. We've sort of looked at it in our portfolios and again tried to go back towards the name where we have the greatest comfort, either in terms of them having a very strong liability franchise or B, having a asset franchise which is tested through multiple cycles. So I think clearly financials are going to remain slightly vulnerable simply because, and we saw this even in 2008, 2009, that the financial sector experienced reverberations of what happened in that business cycle, which lasted well beyond and during that actual period where recovery happened in 2010, 11, 12. So I think some of those reverberations will continue in the financial sector. We've certainly taken a call to go back to only those core names that we feel strongly about and exited some of the names where perhaps they haven't been tested as far as their outcomes on the asset side cycle are concerned.
Fair point. Thank you very much,